Greetings, everyone. I hope you had a lovely Thanksgiving with family and friends. Happy December. Well, today is Employment Friday, but once again, we have no employment report. I think this is the last month we'll be dealing with the absence of information, but we will try and fill in the blanks. So as usual, we'll start with fiscal policy, monetary policy, economic indicators, market indicators. And we'll try to make this a little quicker than we have recently. I'll summarize first by saying, from a fiscal and monetary policy point of view, we think we're at the threshold of an increase in liquidity, and I will get I'll get to that in the charts. And it is important because if this administration wants the economy to be in really good shape by the time of the midterms, they really have to start providing the liquidity now. And I think the big risk in the market's mind is that as the government, both fiscal and monetary policy moves are towards easing, will inflation take off again? That's the biggest question we face. We have a strong point of view on it, as you know, if you've been listening to In the Know for very long. But the burden of proof is on us because inflation does seem to have been stuck in this 2.5% to 3% range for a while now. So we have to answer that question. And I think the biggest answer to the question is if real growth rates start accelerating now, we believe inflation will come down. Many people assume that growth means inflation. That's absolutely wrong. If you look at the 45 years, with the exception of COVID, the 45 years since inflation peaked in the early 80s, when real growth has picked up, inflation comes down, mostly because of productivity gains. And as you know, we think that the productivity gains in this cycle are going to be outsized and sustainable thanks to the convergence of all of the technologies around which we've centered our research. So robotics, energy storage, AI, blockchain technology, and in the life science space, multi-omics sequencing. The convergence between and among those technologies we think is going to be highly deflationary. Deflationary in the good sense of the word. When you cut the price of something, you get more demand for it. COVID was the outlier, that 3-year supply shock, most unexpected in this just-in-time world. We thought technology would get us through that. It did not, and it took a lot longer. So I think there's a lot of scarred tissue associated with rapid growth and supply shocks, but that is not the way the world typically works. So we do believe we'll see stimulus. We do believe it will work, and we do believe it will be obvious in time for the midterm elections. In terms of economic indicators, what you'll see as I go through the charts is employment looks unhealthy. And it always does toward the end of a cycle and as we enter a new cycle. And as you know, we think we've been in a 3-year rolling recession. We think we're moving into a rolling recovery. Employment will lag. It always lags. It's a lagging indicator. But it is going to present headlines that this administration and anyone else running for office in the midterms will have to address. As you'll see, the most cyclical parts of the economy have been weak. Capital spending has turned, though, decisively. And of course, AI is a big driving force there. But we do hear from data centers that the spending is becoming more broad-based than just AI. So that's a good leading indicator. Housing is very weak. Autos are, I would put in the punk category. They're flatlining at a mediocre level from a cyclical point of view. And we do think, of course, affordability is key to both of those. And we believe that affordability will increase significantly during the next year. And in fact, we do believe that housing might be the biggest surprise in the next year. It's been down and out for so long. A lot of people have given up. They feel trapped in their homes by very low mortgage rates, meaning if they were to move, their mortgage rates would double or more. We do believe that is going to change. And we also think that that the administration is very focused on affordability of food, homes, gasoline. Gasoline's cooperating, food is not yet, as I will show you. And we think interest rates, the combination of interest rates and lower prices, especially in the new home sector, those are going to help with the affordability issue. In terms of market indicators, you know, the equity market continues to climb a wall of worry. And as I've mentioned before, walls of worry, bull markets built on walls of worry, tend to be the strongest and most durable bull markets. Of course, this year we had the trade turmoil, and we've had another shudder associated with the government shutdown and the lower liquidity in the system. But we've gotten past both of those, and we're hoping for a swoosh into the end of the year as many more people start thinking about what the economy will look like next year. So we'll go through some charts now, and aligned with fiscal, monetary, economic, and market, ending up with and weaving through some thoughts about innovation as well. Some of these slides are familiar, but I do think it's important to keep focused on many of them, because we think we know what success will look like as we move during the next few years, and success is depicted in some of these charts. And so here's fiscal policy. The budget deficit is beginning to shrink. It doesn't look like much progress, but it is shrinking. I think roughly $350 billion, and about 2/3 of that, maybe a little more, is due to the tariffs. Now, I know in the past, few in the nose, I've been focused on the effective corporate tax rate, which has dropped to 10% in the US. It's really the lowest in the developed world. And I think one of the reasons capital spending is starting to take off is because that effective corporate tax rate is attracting investment into this country, perhaps to the detriment of other countries, but I think it is also expanding the pie in this country. I'm going to talk this time about individual tax rates now that we're facing tax season, and feature a new chart. Again, this is from Piper Sandler. Nancy Lazar and her team do a great job on fiscal policy and delineating the changes. Here you can see what individual tax relief looks like for the next 4 quarters. Now, in the One Big Beautiful Bill, OB3, there were tax cuts, a number of different kinds of tax cuts, along with child tax credits. So we said we know no tax on tips. That'll be important for those working in hospitality this holiday season. no tax on overtime. That's an incentive for people to work overtime. Now, we're not seeing overtime hours proliferate yet, but if we're right about next year, those working overtime will get a nice big break. Another one is lower taxes on Social Security. I think no tax up to a certain level, and that is also a welcome break, especially for baby boomers who are retiring. I think the number is a little over 1 million per year. So good tax break there. The SALT deduction was doubled from 10,000 to 20,000. So those in high tax states get a little bit more of a break than they have recently. And I did mention the increase child tax credit. So you can see the impact on income levels here. So DPI is disposable personal income, quarter to quarter at an annualized rate. So without tax relief, Nancy and her team's estimate was that in the first quarter, nominal disposable personal income, so that includes inflation, was going to annualize in terms of growth at a 4% rate. With tax relief, that will be a 10% annualized rate. And dropping down to the bottom line there, real disposable personal income. So that takes away inflation. What's the real gain in income? It looks like that's going to be, with tax relief, roughly 8% at an annual rate. That's a very large break. That's a very large increase in income. And so we think entering the year, the consumer will have more spending power. Now, one of the reasons the consumer needs more spending power is food prices. And last in the know, when I raised how high the SNAP program, how high the spending was versus the poverty level, it was way out of kilter. But those who wrote in, yes, you're absolutely right. Do we see sticker shock at the grocery store? Absolutely. And so want to show you how much above trend food prices are. So you can see in the purple line is the SNAP participation rate, used to be known as food stamps. And you can see the dashed line is the trend of the CPI. And you can see the arrow pointing to the green CPI level, which is still 16% above trend. So definitely food prices have hit the affordability of everything. If you have to buy necessities, you have less for discretionary spending. So I'm sorry if there was misinterpretation. We were just talking about the kinds of spending cutbacks that were taking place in the context last month of the poverty level. But those writing in talking about food prices, have I been to the grocery store lately? Absolutely. And totally agree with all of you on that. And I think the Trump administration is, as I mentioned before, going to be judged on affordability, both food and housing. Gasoline, we are getting a break, and that is freeing up some spending power. I think oil on a year-over-year basis is down 20%. So moving forward, it is possible that gasoline prices will drop year-over-year 20%. Right now, it's just down a little bit year-over-year, but 20% would be a very nice break. On to monetary policy. Well, there's been a lot of drama there. It does look like Kevin Hassett is the top probability for becoming the next Fed chairman. Now, he is still he now is chairman of the National Economic Council and has been an important deputy to the president, I think, accompanying him everywhere. There is some talk that he will have both positions for a while if he is nominated and approved as a Fed chairman. If he is not, or for some reason the president decides he needs him too much by his side, then we think the second likely candidate would be Waller, and both of them have been quite public about the need for lower interest rates, and also public in their belief that lower interest rates will not cause inflation or stoke inflation, but will stoke real growth and productivity gains that will hold inflation down. So philosophically, they are aligned. Here you can see money growth. Now, money growth is on a year-over-year basis in the purple there, is stalling in the 4.5 to 4.6% range. And you can see, if you look across this chart at the purple line, it is in the lower end, not as low as we reached as the Fed was really jacking rates up and trying to squash inflation. But it is on the lower end of this chart. The other thing, and I have mentioned this in Other in the Nose, is that the velocity of money is also flattening out. And if both of these decline, that will mean serious pressure on nominal GDP. If we're right, real GDP will hold up, inflation will cave more, and that's in the green line. The CPI is in the green line. It's been stuck in the 2.5% to 3% range. We got the PCE deflator today, and it also is in that 2.7%, 2.8% range. The Fed has been railing against anything above 2% inflation. And yet other market indicators have caught the Fed's attention, namely the labor market. And so it is relenting somewhat, albeit haltingly. And one of the other charts I like to share, we did share in the last one, Julian Falcioni, who used to work at ARK, drew this chart. He is at one of our clients now. And it is striking that gold relative to M2, and remember we're saying M2 is starting to flatten out here. Gold relative to M2 really is as high as it's ever been, except for the Great Depression, when the money supply was collapsing, negative. It's no longer that now. And back then, gold was revalued. Or I should say devalued. It was a devaluation of the dollar in terms of gold. And that's why the spike back then. Now we don't have the first condition anymore. Money growth has turned positive. But we do have the second condition in terms of the dollar losing value relative to gold. And I think one of the bets that investors in gold are making is that the liquidity that spewed out during the COVID crisis is still going to find its way into inflation. We don't think so if money supply is topping out and velocity is rolling over. Now, I would like to give you, now that everybody thinks gold has only one way to go, if you look at the last two spikes there, meaning the last two other than the Depression, so the one in 1980 and the one a minor one in 2011. In 1980, gold peaked at $850. I was very young in my career, and I remember the day. And over the next 5 years, 4 to 5 years roughly, it dropped 67%. Why was that? It was because Reaganomics was working, and investors decided to focus on the equity market and the bond market instead of hedging, continuing to hedge against the inflation that had been debilitating during the 70s. Inflation came down and continued falling. And the dollar became very strong. The dollar became better than gold. It was appreciating as gold was going down. And so gold dropped about 67% to $284 in February of 85. So yes, the gold price can go down. And we think we are moving into more than a Reaganomics market. We think this is Reaganomics on steroids, based on, especially on the tax cuts and the deregulation. Those two are much more formidable right now than they were in the early 80s, with the exception of the individual tax rate back then did drop by quite a lot, by 25%, I think, but it was phased in, and that's not the way to go. One thing about this administration, it has learned its lessons from the mistakes of Reaganomics. Do not phase in a tax cut. They made it retroactive. That was very smart. In 2011, the gold price peaked in September at roughly 1900. And by December of 2015, again, roughly 4 years later, we talk about the 4-year cycle in Bitcoin. That's pretty interesting. Both of those were effectively 4 years. Gold dropped from 1900 to 1050. So that was a 45% drop. And we would not be surprised to see something like that happen during the next 4 to 5 years. So on the next chart, just want to give you a sense of or a picture of liquidity. So liquidity moving down, what we told you during the last In the Know was that the combination of the end of quantitative tightening, now that was only on December 1st, so it's hardly had any time to impact, but that is effectively adding liquidity to the system relative to what otherwise would have been the case, to the tune of $30 to $35 billion per month. So that is going to help turn this line up. And then the Treasury General Account, we think, is going to go up. Now, the Treasury General Account cash built to the tune of $350 billion during the government shutdown. It has not, even though the government shutdown has ended, it has not started to unwind that liquidity, but we believe that it will, and actually is in the process of doing so. So we think this line is going to turn around fairly dramatically. Now, just to reinforce what I said before, those betting on gold are looking at what happened to liquidity during COVID, and it doubled. It doubled. These are very big numbers. Doubled from 3.5 trillion to 7 trillion. And now we're back down to 5.5. There is a fear that doubling will reverberate in the form of inflation. We think in the next, as tariffs work through the system, that the surprise is going to be on the low side of expectations, and that those worried about inflation will have to think twice about how they're positioned in the marketplace. Here it depicts the yield curve. It's at the short end of the curve, the 2-year minus the 3-month Treasury bill yield. And you can see this is still inverted, still below zero. And you can see anytime that has happened in the past, certainly for any length of time, we've seen a recession follow. And it has been amazing that we have not been in recession, but as we have mentioned before, we've been in a rolling recession. As the Fed eases, and we do think the odds are 80-90% for a cut on December 10th, this should start moving above zero. And then the longer term yield curve, which I know I talk about all the time, I'm kind of obsessed with it, is I think telling a story. We've put a downtrend here, a trend line, since 2008, 2009. We were surprised during COVID that the yield curve did not reach levels it had reached before when the Fed was fighting recession. It reached roughly half that level. And here we are. Could we be peaking now? Well, that would be very interesting if short rates came down. If short rates and long rates come down, but this yield curve does not steepen anymore, I think it will be telegraphing that there are deflationary undercurrents out there. And hopefully some of the bond strategists will start analyzing it from that point of view as well. Here's just real GDP and productivity. I present this marveling in part that real GDP, the purple line there, the growth rate, has hovered around the 2.5% range in a rolling recession. Of course, government spending and high net worth consumer as stock prices and to some extent bond prices moved up, and housing prices also, existing home prices. So the wealthy have done very well, but the rest of the economy, small business, low, middle income consumers, it is time for them to be able to join this kind of growth rate. And we think that that will happen during the next year. Productivity, roughly a little around 2%. In a rolling recession. That's pretty good. If you look back in history, it's stronger than where it's been or where it was during most of the post-global financial crisis period. And we think it's going to continue to move up, as I've mentioned in the past, and perhaps be sustained in the 4 to 5% range, which would be a real breakthrough, being sustained. We got there at the end of the tech and telecom bubble in the late 90s, but it wasn't sustained. I mean, we went through recessions and a pretty bumpy road there. And the next chart here is just a picture of the rolling recession. Manufacturing sector certainly hit. It's been below 50%. Below 50% means contraction. It's been there for about 3 years. It too is, I think, a rubber band stretched and waiting to recover in this next year. Services, as you can see, or the non-manufacturing sector in green, is starting to show signs of life already, and that's probably the first place you see it leading the manufacturing sector. Consumer confidence took a hit during the government shutdown. It didn't break down on this measure. That's a good thing, but it's important that it increase and include more than just the high income earners, and we think that will be the case. Here's one of the reasons. This is a labor shortage index, and it goes into the early 1900s. You can see major labor shortages during wartime. But what's interesting about this chart is recently, as everyone's been worried about the employment indicators and robots and artificial intelligence destroying jobs, we've had a tick back up in this measure. And we know from the unemployment rate, which is in the low fours, that we're at a fairly low unemployment rate, at least by historical standards. So this is good news for employment, and especially for those who are recent grads. Now, this is one metric of recent grads. It's 20 to 24-year-olds with bachelor's degrees. There's another measure that has new graduates, but this one, is all in the 20 to 24 age range with bachelor's degrees, whether or not they're new graduates. That unemployment rate is approaching 7%. The new graduate employment rate is past 10%. It jumped roughly a full percentage point in the last employment report we saw, which was the September employment report. And you can see on the next page that the duration of employment is also increasing. It's been at a high level, and it now has gone from 20 weeks to roughly 25 weeks. And I think I said this on the last In the Know. If you have to be unemployed, if that's just your lot at the moment, and if you think about it as an opportunity, not only to check out what's out there, what's available out there. I just showed you a chart saying there are some labor shortages, but also to start thinking about controlling your own destiny and learning all you can about AI and about vibe coding that will help you, perhaps you and your friends, build a business to fulfill an unmet need that you see, but that hasn't been solved. And vibe coding, you can go to ChatGPT or Cursor or Replit and Gemini, Grok, and describe the kind of business you want to form and what your goal, your mission is, and prompt it along the way to get you from one point to the next, including a pitch deck with the idea, so that you can perhaps approach venture capital or angel funds to share your idea. This is an ideal moment to do it. AI, the costs are so low. You can. There are some free services. If you want more advanced services and want to be able to use more computing power, then you pay $20 a month, max $200 a month if you're extremely sophisticated. So I want to make sure that everybody seizes the moment, because it is an important moment in our history, and it's really important to get on the right side of change. Here you can see the quits rate. This usually falls when people with jobs are reluctant to change jobs because they're not sure there will be another job for them out there, or that it will pay them anything higher than they're making now. So this is another indicator on the weak side. Again, employment is a lagging indicator. Savings rate is, it's not at its record lows, but it doesn't suggest there's a huge amount, a huge buffer for a rainy day. And that's probably because of food prices and other affordability issues. So it's really important that we see employment pick up and strengthen here, so that the coffers fill for a rainy day over time. Here is, from an affordability point of view, something that is going right. The mortgage rate is coming down 80 basis points. We're not a full 1 percentage point yet, but it's moving in the right direction. And yet, this is what buying conditions for houses seem to be like for consumers who are part of the University of Michigan Consumer Sentiment Survey. While there's been a bottoming out, to me it is really striking to see this metric as low as it was in the early 80s, when interest rates were in the double digits and some mortgages were 20% at a 20% rate. Again, as interest rates come down and perhaps new home sale prices come down, this number will go up as people more and more people are able to move. Here's the sales volume. Again, shocking. I mean, these were the volumes in the late 70s. So housing is a sector that could really surprise on the high side of expectations if we get this virtuous cycle going in the next year. Here is why we think prices will fall for new homes. Inventories are very high, almost as high as right before the global financial crisis. So builders are holding inventory, and it's expensive. So they will probably, as the housing market picks up, they will probably want to sell, even if they have to take a haircut, so they can participate in the next wave of housing and invest in it. Here, real estate prices, new home prices down year over year for almost 3 years now, not plummeting, but down. And existing home prices or price inflation very low by historical standards. So we do think this also will feed into the inflation measures. CPI, 40% of the CPI is shelter. A huge part of that is housing. And so this decline in new home sales and slowdown in the inflation associated with existing homes should really help the inflation indicators during the next couple of years. Auto delinquency is another sign that people are hurting out there. I am not as alarmed about this one being close to 08, 09 levels, because back then there was no Uber or Lyft, and people were choosing to default on their homes rather than their autos because they needed to get to work. Today, we do have Uber and Lyft, so I have a feeling this will go higher again because labor is a lagging indicator. Here, we're getting a real sense that there's momentum developing in capital spending. And you can see what's so interesting about this one. From the early 2000s, it used to peak in the $65 to $70 billion range. And we've broken through that. And even though we went through a rolling recession where capital spending did suffer, it did not drop back to that level. And in fact, now it's turning around and reaccelerating. This is a clue that the tax policy is working. And so we expect it to break out to all-time highs and to be very strong. And this is one of the biggest multipliers in the economy. A multiplier means for every dollar spent in capital spending, that the reverberations in the rest of the economy were very high, many more dollars of activity created. Here you can see the trade balance. So we're coming to the end of economic activity. So consumption, investment, including housing and capital goods, trade, and government spending we addressed earlier. So those are the four major categories. Here you can see the trade deficit is kind of getting stuck here again. It's improved a lot since its depths when we imported huge amounts earlier this year to avoid tariffs. So it's kind of right sizing from that angle, but it isn't, it's not anywhere near a surplus. And if we're right on what's going to happen here, where the US economy is going to grow faster than most other developed economies around the world, this probably will not get any better. Import growth will exceed export growth. And here, I'm sure this is quite annoying to President Trump and the administration, but China's trade balance is $100 billion per month. Per month. And what that's saying, we think, is the domestic economy in China is very weak. And the rest of the world, starting with China, is sustaining the Chinese economy. What does that mean? Probably means they're exporting deflation, which is another deflationary undercurrent that I don't think people appreciate. Even President Xi Jinping is saying, hey, wait a minute, great, we're commoditizing everything and lowering the prices, but we're also killing our own industries. Let's be a little more thoughtful about it. That's kind of good news from a profit incentive point of view, and an invitation for more investment. Here's the dollar, just reassuring people it's not falling apart, although one of the big surprises is that the Chinese yuan is appreciating. Or I should say, I should reframe that. The Chinese, yes, it is appreciating, and it would probably be appreciating even more if the Chinese were not trying to manage it, because they do have a huge trade surplus. That an appreciation is actually adding to the deflationary forces inside China. And so that's why they're trying to manage it. They do not want a deflationary bust. Here you can see the S&P 500, and I think the latest kick up is consistent with this idea that capital spending is starting to take off. These companies have managed through a difficult time, COVID, its aftermath, and so forth. They're using AI tools, increasing their productivity, and so earnings are taking off, and they are freer now to increase capital spending. Here is just on market indicators now. Commodity prices are firming a bit here. You see on the Bloomberg Commodity Index. And so we'll see what's happening. This could be in response to early signs of strengthening activity and maybe a washout of inventories, that being over. So we are not looking at this right now as an inflation indicator, but more an indicator of supply relative to demand as we move into a rolling recovery and ultimately into a strong one. This one still puzzles me. This is the metals to gold ratio, lower than 0809, lower than COVID. Something's not right out there. That's the purple line. And we think it's China. And we are seeing a lot of deflationary signs in China. The long bond yield, however, is sticky and has not been correlated with this metric the way it has been in the past. And it's a bit of a puzzle. I guess the biggest explanation is many people think that government spending is out of control and they want to be paid for the risk they're taking. Maybe that's as simple as it gets. And we'll put it in the context of history. Copper going up, I do not think that's an inflation indicator. A lot of the electrification of the world, including transportation, is very copper intensive. So this is supply demand at work. And here again, market and price indicators, S&P to gold. Again, watching that 70s period where it was a waterfall, there are some people betting that inflation is going to be that problem again. We are not, but this is in a holding pattern, and we think it will test, and the next move will be up, test well, and the next move will be up. but we are monitoring it closely. Here is, we think, a leading indicator. You see this S&P price to oil price plummeted during the inflationary 70s. It's doing the opposite now. So this, we think, is a leading indicator to the S&P to gold ratio. And here you can see long-term interest rates over the last number of decades. The peak, the double-digit peak in 1981, and the trough during COVID. And so the question about today's rates is, are we simply back into a period of normalization? Just the market working and 5%, 4 to 5% being roughly the GDP growth rate, and interest rates following. I don't know. We will have to wait. My guess is we will see a leg down toward that 2.5-3% range, and that will be closer to the new range for the next few years. Spreads, the spread between high yield rates and the 10-year Treasury rate, a measure of credit risk building in the system. The market's not seeing it. Again, I say it's hard to believe. We hear first plans going bust, and we hear some turmoil in the private credit market, and yet you don't see it here. Maybe there's just too much money reaching for yield, and that's where the bubble is today, not in AI. Many people think AI is where the bubble and the risks are. These are credit default swaps for Oracle and even Apple. And you can see what's happening here. These are insurance policies against defaults. And when they go up in price, it means there are investors. And we think the banks could be laying off risk here, who think that maybe the spending spree in data centers is just too much. So we don't think so. We like this wall of worry. We like the concern, scar tissue from tech and telecom bubble. It's all a good thing. And I'll end, as usual, Bitcoin to gold. This has the drop in Bitcoin, we think, was more, well, first of all, it was more severe than we expected. And I do believe it's because of the liquidity constraints and restraints that we have seen during the last couple of months. We always believed those would be short term, and still believe they will be. And so if we are right, we believe that the Bitcoin to gold ratio will resume its uptrend, especially if what I said when talking about the gold to M2 chart is correct. So anyway, I guess a little longer than I expected, but thank you, and have a wonderful holiday season, Hanukkah, Christmas, and enjoy time with your family and friends, and look forward, we believe, to a very happy 2026. All right. Thanks so much.